Howdy, all right, a little later in the evening here on December 16th. And I just wanted to do a quick video on natural gas prices in Euro land and how that might affect crude oil prices. So this is a chart of Dutch natural gas, and it is priced in euros per megawatt hour. So you actually have to translate that. It's a bit of a task, I guess, to translate that, but in terms of energy equivalent, that is $298 a barrel of oil. So you can just get a sense of just how out of whack or how extreme that price is, and get a sense of how much consumers ultimately are having to pay for power in the EU. So we maxed out at about $140, $150 a barrel back in 2008. And that really destabilized our economy. So this, in my mind, even though Europe is somewhat more immunized against high power prices, and natural gas isn't as large of a percentage in their mix in terms of PCE, personal consumption expenditure, this is still very significant. This is a huge jump. A year ago, the prices were less than a fourth of this. So they are going to feel it. People are going to feel it. And the point of this video really, though, is to say, hey, you know what? At this price, crude would have to be $150 a barrel for it to not make sense to switch over from gas to crude. So if you're in a facility that can use either, you are highly incentivized to burn crude oil. Usually it's going to be some sort of fuel oil. And this graph here shows just how large of an incentive that would be. Ignore the x-axis here. Those would be dates, but the dates are, some of this is weekly data, some of it's daily. So it kind of mixes and matches. But you can kind of see that we started getting this incentive to switch back in September, late September. That lasted through late October. There was like a couple weeks where it went flat, where it stopped making sense because gas dropped sufficiently. It stopped making sense to switch. Okay, there was maybe a week of that, 2 weeks, and then by mid-November it was back to the switching making sense. But now we're in a whole nother land here in the past just week, let's call it, where this has really taken off. So it's sort of impossible to ignore. If you could burn crude instead of gas, or you could burn coal instead of gas, you're going to switch. So incrementally, this is a support for crude oil. Now, is it 100,000 barrels a day, 200,000 barrels a day, 500,000 barrels a day? I looked around and I could not find much data on that. So I don't know. I don't know the answer to that. All I know is that if you could do it, you would be doing it at this point. And so it can only be a tailwind to global crude oil prices. So whether it's a 1%, 0.5%, or 2% effect, I can't say that. I don't have the data. I would imagine it's on the order of 100 to 200,000 barrels a day. So not a big deal. We're talking about maybe for the whole winter, lower bound 3, upper bound, let's say 30 million barrels. But it is an effect. So, it's yet another support for crude oil. I think crude oil remains a tight market. And although there are lots of concerns with Omicron right now and with the stock market, fundamentally, I see this as a tight market. It's going to get tighter. And I think crude oil prices, after this nice retrace that we're having right now, I think crude oil prices are going to resume their impressive bull market. All right, that's all for today, or that's all for right now. I'm going to make another video, a couple videos on the S&P. Thank you.